Hey there, welcome back to the podcast. I'm glad you're here. Hope you're having a good start to the year. I thought it would be a really good time to jump in today and talk about what's going on with the Iran war and how that's impacting markets and personal finance and kind of how to think about and contextualize that to your personal financial situation. I'm not trying to predict anything. Obviously, I always caveat with that, but I thought that this was a pretty good time to record this here in late March, recording this on March 24th. I know it changes daily, what's going on in the war. So that's the day I'm recording this. I'm going to talk a little bit about how to contextualize this in the history of markets and then get into the personal financial implications of what's going on. All right, let's get into it. Welcome. I'm Erik Baskin, an Air Force Academy graduate, turned veteran entrepreneur and certified financial planner. I help military families and veteran business owners achieve financial freedom. All right, so I just want to say off the top before we get into any market and finance talk that given the uncertainty, right, nobody really knows what's going to happen. So I'm certainly not going to predict anything. I think here in 2026, information moves so quickly and things happen so quickly and swing back and forth very quickly that we don't really know, right, what's going to happen. That's okay. It can be a little scary at times. So nothing I'm talking about today is really predicting anything. That's just to help you contextualize maybe what's happening. Think about it in a historical context with data, and then think about how some of these headlines you may see, you know, if you're scrolling Facebook or reading the Wall Street Journal, whatever it may be, kind of how some of these might be prognosticating, you know, things that are probably not going to happen, right? And impacts that probably won't happen. So lots of headlines out there, lots of places to get news. I just want to kind of give you a dose of just data-driven thoughts here on what's going on with the war. So first, let's talk about market data, what happens typically during wars, right? On the data we have, you know, all the way back to the world wars. Overall, fairly short-term declines. I think you'd be shocked at how small that average decline is, looking at the data and how quickly that recovery is. So I'll put a link to this in the show notes in the resources section, but this Investopedia article I found, right, has some data from LPL Financial showing the average S&P 500 drawdown after a major geopolitical event is about 4.6%, with stocks recovering within about 6 weeks. So if I asked you those questions without giving you the data, you probably would have guessed a lot larger of a percentage and a lot longer of a recovery. It's much, much shorter than you probably realize. Just reading off a few of the recent conflicts and, you know, what happened. The Russian invasion of Ukraine, right? That was a 6.8% drawdown. That's how much stocks went down. The Israel-Hamas war in 2023, that was a 4.5% drawdown. The strikes on Iran last June, markets dropped about 1.5%. So it's in recent memory, in recent history, any sort of geopolitical conflict has been very, very shallow declines, and they've recovered very, very quickly. And if we think back to it is geopolitical, it's not a conflict, but the tariff war of April of 2025, kind of like the most recent. I remember the day President Trump said that he was going to pause tariffs for 90 days. Markets were up 9 to 10%. I remember somebody telling me, hey, have you seen the market today? I hadn't looked at it yet. Kind of crazy how that quick of news can swing markets back in the positive direction. And I would expect nothing less with the ending of, or the de-escalation of this Iran conflict. Even going back in this data to the Kennedy assassination, 2.8% was the total drawdown. A year later, the markets were up 27%. So we can go back through history, through things much more widespread and much greater conflict than this Iran war in terms of number of countries involved, etc. And we can see those drawdowns are generally not as bad as you'd expect, and markets bounce back very quickly. So lesson there, we have no clue when this thing's going to turn around from its shallow decline, right? Markets are down. I'm speaking right now on March 24th. I just looked it up. The S&P 500 is down about 5.97%. So about 6% from all-time highs. That's honestly nothing out of the ordinary, even if there wasn't a war going on. That could be due to any number of things, AI, some bad news on earnings. That's just normal intra-year moves in the market, right? Things that happen normally during the year as markets go up and down. Okay, now on to kind of broader economic impacts, things like oil, inflation, and interest rates, right? So oil is the big thing you're probably reading about in the news right now and seeing, right? The Strait of Hormuz being effectively blocked by Iran right now for 20% of the world's oil that travels through that area. So typically, this is obviously going to cause prices to rise. I'll put a link to this in the show notes of US gas prices, right? Because that's what we're kind of seeing at the pump, and that's what the consumer is seeing. Obviously have risen substantially in the past month, with the average price per gallon going from January 12th from $2.77, all the way up to $3.96, so over $1 per gallon. So you're definitely seeing and feeling that. If we zoom out a little bit though, and look at it like on a long-term perspective, in June 2022, right after Russia invaded Ukraine in February, gas prices were $4.87 per gallon. Like we zoom out even further, right? In 2008, summer of 2008, gas prices were $4 a gallon. So inflation adjusted, right? That was a much more expensive time to be purchasing gas. So I'll put this in the show notes, but macrotrends.net has a really nice chart adjusted for inflation, what those gas prices are. And we're kind of just like in the median of where we've been the last 50 years or so. Prices were incredibly high. On this chart, the all-time high, it was in June 2008. Prices were much higher in 2022. I'm not saying they won't go higher, right? There's a lot of things that could still happen, but gas prices for most folks just depends on obviously how much you drive, how much it's going to hit your wallet. But this is the first thing you're going to see in the headlines generally, and we all notice it because we go to the pump, whatever it is, once a week, twice a week. But what this leads to is inflation, right? So if gas prices are higher, inflation is going to likely be higher. There's other things that pass through the Strait of Hormuz, right? And other global trade that will be impacted, that will likely disrupt supply chains and raise inflation on all kinds of different products. So that if this is a prolonged war, could definitely happen, and it's very likely to. We haven't seen this in the data yet because inflation is always a lagging indicator. So it takes time for that to reach, all of our goods here in the US where we're measuring that inflation. So this is a prolonged war. We'll obviously see that in the data. But what does that lead to then? Oil leads to inflation, right? Which leads to interest rates rising. So the Fed has already come out and said they may raise rates this year, potentially to fight the coming inflation because of the war. So you can kind of see how those one things leads to another. What's that done to things like mortgage rates, right? That's made them spike a little bit in the past few weeks. Mortgages were trending downward really nicely to lows we hadn't seen since 2023 or so, 2022. We've definitely seen an uptick in the last couple weeks with the average 30-year mortgage, right? This is from Mortgage News Daily. I'll put this link in the show notes as well. Gone from 6% to 6.5%. So mortgage is jumping about 0.5% just in a couple weeks span, right? What's that going to do? Potentially cool the housing market a little bit, cool housing prices a little bit, certainly make borrowing a little bit more expensive, not only in the mortgage market, but across all different product lines, whether you're getting a car loan or any kind of business loan, everything just being a little bit more expensive. So you can kind of see that macroeconomic picture. Strait of Hormuz, oil being disrupted, prices going up, right? Other supply chains being disrupted, it leads to inflation. That's going to lead the Fed to keep rates higher for longer. And you're going to see that borne out in our mortgage market and other interest rate markets. Okay, so now that we know what the history of markets is and wars, we've talked about maybe what might happen with inflation, oil, right? Interest rates and rates in general in the greater economy. What does that mean for you? How to think about this in your situation? I'm going to sound like a broken record, but I think like normal good financial planning and investment principles just apply even more so in times like these, right? So if we look at markets, continuing to invest through up and down markets, continuing to hold the portfolio you do with conviction, regardless of geopolitical events that may last a day, a month, or a year, right? That's even more important now, right? So we've seen, I just point back to the recent history with this current administration in April of 2025, how quickly the quote unquote tariff war ended and how quickly markets bounced back and never ever looked back. Haven't been back to prices like that since. Even today, we're up 29.25% from April 2025 lows before President Trump announced that tariff war was effectively paused or over. So markets have never looked back since. You don't want to be on the wrong end of that bet by jumping in and out of markets or getting a little skittish around a geopolitical conflict like the Iran war. On the broader topics of, oil, inflation, interest rates, right? We don't control any of that. So maybe you can control if gas prices are higher, maybe you drive less. I don't know if that's obviously very personal to your situation. For most folks that gas is not going to be a huge ticket item, in their expenses. It's probably not going to impact them too much for gas, with gas being, $1 more per gallon. Again, historically, it's not that high of a gas price right now yet at this point in March of 2026, right? It could change. But what do we do, in our personal financial situation? We spend less than we make. We monitor our expenses. Maybe we're budgeting if we need that. We have, 3 to 6 months of living expenses for things that might come up, right? Inflation increases and all of a sudden certain parts that maybe are in some HVAC replacement that we need just spike. There are things that can happen, right? That you could point to, oh, that was the tariff war, or that was the Iran war. But how do we buffer against that? It's spending less than we make, having good reserves, and investing, a good percentage of our income to match inflation, right? So when we talk about inflation, how do we fight inflation? We don't put money under the mattress. We don't put it in our checking account where it earns 0%. We have our reserves. Sure, we have that in high yield savings, but then we're investing in global US and international stock markets to take advantage of increases in value of the greatest companies in the world. And when inflation is rampant, right, when it gets to that 8% that it was not too long ago, stock markets reflect that. And if we're not participating in those, we're really losing out with that money that is just sitting on the sidelines. One thing I'll also add is it's okay to be like a little bit, not afraid, but just concerned, like with what's going on in the world. Like there's nothing wrong with that. I'm not telling you not to think about it or look at the news. In fact, just being an informed citizen, like I think there's something there that's good for everyone, but there's just a healthy dose of it, right? There's a difference between reading The Economist once a week or reading the newspaper once a day. That versus, scrolling on TikTok, Instagram, or Facebook. Reels or something that's made by someone trying to sell you something or get your attention so that they can sell ads, right? Facebook, just prognosticating on what the war and how bad it is and how it's hitting oil prices and all that. That's usually not very helpful and thoughtful content. And I would just caution you during times like this to really reassess your news sources and where you're getting news. Is that far left? Is it far right? Hopefully it's somewhere in the middle just so it can be somewhat unbiased. And then how often are you reading that? Is it hourly? Well, that's probably too much. Is it monthly? Well, that's probably not enough. Just find that happy medium and those good news sources and a good cadence to where you know what's going on, but you're not prognosticating over doomsday scenarios and things that may or may not happen. All right, that's all I got for you today. Thanks so much for listening and being here. Shoot me an email, Erik, E-R-I-K, @BaskinFP if you have thoughts or questions. We'd love to hear from you. And I'll see you next time. Thanks. Thank you for joining us today. We'll be back with some more content to help you on your journey to financial freedom. See you then. This is a friendly reminder that the podcast is general and educational in nature and does not constitute tax, investment, legal, or financial advice with respect to any particular individual or taxpayer. Please consult with your own tax, legal, financial, and other advisors regarding your own unique situation.